Hey, what's up everyone? Welcome back to the channel. Over the past week or so, we've had most banks reporting earnings, including of course the big five. And because banks and investment firms are one of the biggest indicators of how the economy is doing, well, in today's video, we're going to take a look at how they performed in the first quarter and whether any of that is signaling a weak economy or looming recession, which by the way, the CEO of Chase, Jamie Dimon, biggest public bank in the world, he just said that the chance of a bad economy is higher right now than people think. Plus, we also had the Fed meeting recently, just this past week, and they hinted towards higher interest rates for longer than expected, which can easily trigger a recession. So let's examine some of this a little deeper, and I'll share my own thoughts all along the way too. Let's go ahead and jump into it. All right, just for some context here, the five largest banks in America are, of course, JP Morgan Chase, followed by Bank of America, Wells Fargo, Citigroup, and US Bancorp, together holding many trillions of dollars in assets and several thousands of branch locations. Now, in terms of how they did on earnings, well, Chase was, in my opinion, the best performer, as their recent acquisition of the failed bank First Republic resulted in an increase to their loans and therefore their net interest income on those loans as well, because of our currently high interest rates that have been really raking in record profits for banks recently, with Chase alone doing about $50 billion of net income just last year alone. And as such, they not only beat analyst estimates last quarter, but they also saw a double-digit rise in sales year over year to over $40 billion, with another 6% rise in net income as well to over $13 billion, which is hugely impressive, by the way. And again, much of that was due though to the acquisition, but it should be noted that their net income would have actually been even higher if it wasn't for all of the fees that big banks are having to pay because of the recent bank failures. However, despite JPM's strong performance, many other banks are actually seeing a bit of an opposite effect take place, where their loans and financials are actually falling, signaling a period of weakness rather than strength, if you can believe it. For example, Wells Fargo saw their net interest income, drop by 8% year over year, despite the high interest rate environment. And they said that it was mostly due to increased funding costs from those higher interest rates that caused customers to switch over to higher yielding deposit products while also decreasing their loan balances. How crazy is that? They're actually starting to feel negative effects from the high interest rates. Meanwhile, the fifth largest bank in US Bancorp actually cut their outlook for interest income this year, and the fourth largest in Citigroup reported a 5% drop in sales with over a 26% drop in net income profits too. Now granted, Citigroup has just gone through a major restructuring with lots of one-time charges there, so I wouldn't really put too much weight on that net income crash, which similarly, it's not as concerning that the second largest in Bank of America saw their profit fall by another 18% too. But like the others, BAC saw their revenues fall in the quarter as well. And that is very alarming to me, because the fact that these banks can't even grow their sales in this favorable environment tells me that the only reason JP Morgan was actually seeing some positive results was probably just due to that acquisition of First Republic, when in reality, the economy is actually much worse than we think, which brings me over to that first report I showed you guys about Jamie Dimon, the CEO of Chase. He gave mixed signals about the economy, some of which is alarming to me, but let me break some of this down for you. So here's some of the comments here. He said that many economic indicators continue to be favorable. However, looking ahead, they remain alert to a number of significant uncertain forces, citing growing geopolitical tensions and persistent inflationary pressures that may likely continue, adding that they don't know how these factors will play out. Of course, I showed you guys last week in my media lying video that the inflation rate has not only risen in each of the past 2 months despite our incredibly high interest rates, but also that inflation is cumulative, meaning that it's only been getting worse every year as prices continue to snowball larger and larger, growing out of reach of most consumers, which over the 4 years prior to the pandemic, we only saw total inflation rise by about 4% before it absolutely skyrocketed by 24% right after. Of course, these are insane levels of inflation that most people will struggle to afford, and as such, during the Fed's latest meeting this past week, Chairman Jerome Powell stated that because of this lack of progress on taming inflation, they're going to have to keep interest rates higher for longer than previously anticipated, and that they are willing to keep them this high for as long as needed until they see more evidence that inflation is actually coming down. And that's leading to a fear that we may not actually get maybe even a single rate cut this year, whereas the Fed had previously signaled for at least 3 rate cuts at the start of the year. And just so you know, rising rates almost always causes the economy to crash and go into recession. In fact, another thing that they often do is invert the yield curve, which since the 1970s has always been followed by a recession within 18 months. And right now, we're on month 21, so that's kind of scary. Anyway, going back to the Chase report, well, surprisingly, Dimon actually said that American consumers still have excess savings and that stocks are higher and unemployment is low, adding that even if we go into a recession, consumers are in pretty good shape, which I'm sorry, but that's pretty wild to me because I can show you lots of evidence to the contrary of that. But just to finish up here, he did also say that lower income earners are quickly running out of extra money and that the bank is beginning to see cracks in the subprime auto loan market, adding to that market pricing is likely too happy at the moment and that the chance of a bad outcome is higher than people think, all of which I do agree with. The stock market is extremely high right now, and I think a correction is desperately needed, which obviously if there's a recession, it'll probably crash. But then he also said that the important thing here is not the economy or whether we have a mild recession or soft landing, but rather it's the future of the free world, referring to Russia's war on Ukraine, and that it could be determinative on what happens to the global economy if oil and gas prices go too high. Okay, so there's a lot to comment on here, but I'll try to just kind of keep it as short and simple as possible. Now, first of all, when Dimon says that consumers are in pretty good shape, even if we go into a recession because savings are high, stocks are high, and unemployment is low, that's a sentiment that I strongly disagree with. I personally think that one of the biggest reasons why unemployment is supposedly low and income is up is because people are taking multiple jobs and working overtime just to afford anything. I mean, I showed you guys last week this article from Redfin. It's one of the largest real estate companies out there that said consumers are literally skipping meals and working overtime just to afford their rents, which by the way, rent prices have risen by around 24%, while house prices have risen by closer to 60%. Not to mention the giant amount of small businesses saying that they may not even survive this year, with optimism at more than a decade low, citing inflation and higher costs and labor. So how is everyone going to be fine if things get actually even worse and we go into a recession? That doesn't make a whole lot of sense to me. And I also don't buy that consumers have extra savings right now. I don't know a single person in my circle of family and friends that is bragging about having too much money in their bank account. Most of them are living paycheck to paycheck. This last tax season was pretty brutal for a lot of people, myself included, by the way. And I have a lot of people telling me that they feel the economy has only been deteriorating in recent years. But even if I give Jamie Dimon that point and I say that people are somehow saving money in this economy, that still means very little when you're drowning in record levels of debt, because credit card debt alone has skyrocketed in recent years to over $1 trillion, let alone mortgages, student debt, personal loans, car loans. The only reason consumer spending really is still high, in my opinion, is because we're using mountains of debt to afford anything. And good luck paying all of that off during a recession when things are, assumingly even worse. By the way, I'm not trying to sound overly negative on all of this. I'm still a long-term optimist about both America and the stock market. And I think high interest rates and maybe even a recession is kind of needed right now to correct our economy and bring inflation down, which if that happens, then the Fed can also, they'll also be able to lower rates coming off of that. And that usually sends the stock market soaring and it boosts the economy. So it's not all doom and gloom. But I'm saying that more from a long-term perspective, whereas in the short term, it really does feel like we keep kicking the can down the road and pretending like everything is, rainbows and sunshine, when in reality, the economy is, in my opinion at least, pretty bad right now. And you're welcome to disagree with me for sure, but I'm just saying that's my opinion. I don't feel like things are that great right now. And by the way, Dimon and even the Fed are admitting to much of that, which I give some respect to. And Dimon mentions the Russia-Ukraine war. Keep in mind, Russia is the second largest oil exporter. So if oil prices do keep going up higher, then yeah, we can expect inflation to linger on because, so much of that is used for energy and heating and transportation, even making plastics and other things. So I agree with those points there as well. So, I guess kind of my overall conclusion here is that there is a lot to be concerned about. I'm not a fortune teller. I don't know if a recession will hit us anytime soon. But I do think that the Fed and bank earnings are pointing to a lot of issues that can certainly bring a recession. So I don't think that that's off the table right now. But I will keep you guys posted and I'll keep making occasional updates on this for as long as you guys want to see that. But I would also love to hear your perspective and your thoughts and opinions down below. So please share any comments that you'd like down there in the comment section. Like I said, I'm a long-term minded investor. So I'm going to keep investing in stocks long term and try to build up, as big of a portfolio as I can. But I also can't just ignore the short-term problems either. I focus on having a good job and a stable career. I think that should be number one priority for everyone. And then when I can, I also try to save money outside of the stock market too, in case it crashes and I need to go in and buy heavier on the dip. And I think those are things that everyone should kind of keep in mind. But anyway, I hope that regardless of all of this, you're doing well. I wish you the best of luck with any decisions you make. And yeah, if you have any questions, feedback, drop it down there in the comment section. But thanks again for all your support, my friends. It means a lot to me. I'll catch you in the next one. All right, take care, everybody. Bye-bye.